Good morning, everyone. Welcome to this update for global stocks and commodities for the 8th of July. With pretty nervous markets over the last couple of weeks due to the trade tariff dispute, it's brought out all the bears again. A lot of people talking about whether this is the end of the now 9-year bull market. And looking at all the information, and whilst I always try and retain a very open mind, I just have to come to the conclusion that all of the indicators are that there's still more to go in this bull market yet. So let's jump in and have a look at the data and the price charts. So we've still got the US economy is clearly leading the world. There's no question about it. Europe was looking better there for a while, but certainly has cooled off a little bit, and so the US economy remains the bright spot of the world, and the US stock market is proving to be more resilient than anything else as well. Particularly with the falls that we've seen in the last week or two in China, Japan, Korea, Singapore markets, they've all been hit very, very hard with 20% declines and more. So I want to have a look at what is needed, what is likely to change this current weak sentiment if the bull market is to continue. There'll be the normal stock and commodity trend update, of course, and Portfolio Analyst last week looked at a number of things, how to position your portfolio in these kind of uncertain markets, how to make those adjustments. I looked at a lot of entry setups that I'm waiting for on particular stocks, and also in response to a member question, had a good look at the comparison between Amazon and Alibaba, both fundamentally and technically. So that was a very interesting session, and of course, there's anyone who's not a member of Portfolio Analyst has the ability to join up for a couple of weeks under a free trial basis, and you'll see details of that below this video. So American stocks, the S&P ended up 1.5% for the week, so it was a good finish, and the trade dispute took very much a back seat to what was quite a good June jobs report on Friday, and I guess hopefully that will get the market refocused back on the things that it should focus on, and that's earnings, because it's earnings that drives markets in the long term, and markets have a habit of getting distracted with shorter term implications, and everybody is projecting that this trade dispute will escalate and it will be the end of the world and stocks will fall forever and all sorts of doom and gloom scenarios. And frankly, when you look at some of the more sensible analysis of what it actually means, the impact on China is not that great. It's only, their exports have become a far lower proportion of their GDP. They've been swapping their economy over the last 5 to 8 years from being an export-driven economy to a consumer-driven economy, and they've progressed a long way in that respect. The amount of ex-Chinese exports to America is now quite a small proportion of their overall economy. It's just not a sensible way to go about things. Just look at everything from the negative. And I've been reading some data of late that really shows that there could be some good positives already starting to come out of this, particularly with respect to tariffs on cars between America and Europe. So, the discussion has all been one way, and it's been negative. But there's another way to look at this as well. Sentiment, I believe, is what I would call encouragingly bearish. There's no way known that you get a market top when sentiment is as bearish as it is right now. So I'm actually seeing that bearish sentiment as a real positive, and hopefully Friday night turnaround was the start of that. And if we can get a good earnings season, and certainly the expectations are fairly high for the earnings season about to start, then I think the market will get focused back on the fundamentals. The price of stocks is driven by the earnings per share growth that they are tangibly showing, and also by the forward guidance. And over the years, the American culture is a bit different to the Australian corporate culture, and that is that they tend to under-promise and over-deliver, and everybody's happy with that scenario. And there's no incentive for US corporate leaders to be upping their guidance. That it's much more productive for them to go to lowball the guidance and then beat it. Yet we've seen in the last 2 quarters there's been a huge upsurge in American corporates upgrading their forward guidance. So that tells you how confident they are about where things are going. And forward guidance is now the strongest that it has been in years in America. So I'm expecting this earnings season to be a good one. The average for the S&P for the second quarter earnings growth is 20%. And that compares with a full year expected 2018 P of 16. So, how anyone can say this market is overvalued or grossly overvalued is, I'm not sure what data they're looking at. So that's the situation with American stocks. Now the US dollar backed off across the week, and I don't know whether it was driven by fundamentals or by the technicals. The Fed minutes showed that the rate of increase may not be as strong as some people first thought. That probably played into it a bit. We got a bit of a rebound in the euro from oversold, so I think all those things sort of fed into a bit of weakness in the US dollar. So let's jump in and look at some charts. We'll start with the S&P, and you can see we're still within the box. If you want to look at it that way, we've got a big consolidation range, and we are still in that consolidation range. We're holding towards the top of it. I'll just remove that. So we're holding towards the top of it, and we're still in the trend channel. We're in the lower part of that trend channel, but definitely trending still higher. And I don't know in the very short term whether this is likely to go down to the bottom of the trend channel, perhaps somewhere around the 2660 mark, or whether in fact we'll get a breakout above 2800. But I'm pretty confident that we will see a breakout above 2800 and then above 2875 by the end of the year. There's just too many things in favour of that occurring for it not to be the situation. Now the Russell also rebounded very strongly last week. In fact, again outperformed the S&P, and we've had a bit of a dip from all-time highs, but we're rapidly closing the gap on that again. And if we look at the Nasdaq, it's a very similar pattern to the S&P. To the Russell. Technology has been the strongest sector for years. We had a big dip around the trade tariff dispute, but that's quickly picked up pace again now. So that's the situation with American stocks. If we look at the dollar, we ran up, had a little peep over 95. We're getting a bit of a pullback, but I think it's likely at this stage that this is just consolidation beneath that resistance, and that we may see a continuation of that uptrend, particularly given that we are now seeing weakening economic data in Europe. I think that's going to have a bit of a negative effect on the euro, and that will also help the US dollar as well. So that's the American market. The Aussie dollar went up slightly, and that's really just consistent with the US dollar going down. We had a huge dip in the Australian dollar on Monday, and then we managed to recover throughout the week, but that's really just the US dollar coming down. The ASX 200 rose by 78 points on the week, with almost all of that on Friday. So that was a 1.25% move, and it was a new 10-year high in the ASX 200. Who would have thought? And it was only a couple of weeks ago that I said that I just couldn't see what could propel the Australian index higher. But in fact, the banks were the main driver. But I still believe that there are so many things against the banks, and It could just be, I don't know whether it was a coincidence or not, but the dividend checks went out to bank shareholders last week, and we could have seen those being reinvested in the bank stocks. So was it just the dividend checks and this rally's going to run out of steam? I don't know. I don't spend too much time thinking about it, to be honest, because I don't really participate in that part of the Australian market. My activities are really the small to mid-cap high growth stocks. So let's take a look at the ASX 200 just for the record, and you can see there we had a consolidation of that nice move a couple of weeks ago in mid to late June, and then a really big move on Friday. So there's a new 10-year high. We've got to go all the way back to December of 2007. But if we look at the finance index, so we'll just wind back a few weeks, and I was noting this breakdown. We had a breakdown, we had a rally back to test resistance, and then it started to fall away and it looked very, very ugly. We've now got a bounce, but we've only bounced to the 200-day moving average, which is pointing down. So as far as I'm concerned, the Australian index is still in downtrend, and with all the negatives against the banks, I certainly wouldn't be getting excited by what's going on in the Australian market, other than being a very select stock picker. Okay, precious metals now. Gold rebounded a couple of dollars to $12.56, but it's been really quite weak as interest rates have gone up, and I think it was really just a bit of a turnaround from oversold. Precious metal stocks, GDX looking just a little better, so that glimmer is getting slightly brighter, but not a great deal. But it's the Australian gold producers that are just killing them at the moment. If you want to participate in the gold sector, then it's the Australian gold producers that are providing the rewards. Let's just take a quick look at gold. Gold on a weekly chart, you can see we've broken that trend channel, which is not a good thing. And then we've had a bit of a steadier last week. If we look at the daily chart, quite a nice turnaround on Tuesday, but after that, not much happening. And if we go to GDX on a weekly chart, you can see it did tick up a little bit, but really it's still just within this big consolidation that has been the case now for 18 months. So it's been a fairly boring, lackluster sector at the global gold stock level. Turning to other commodities, copper declined very sharply to 285, and this is a bit of a concern. Key support was broken. On the surface, it looks very ugly. But these things can turn around. As we were just looking at the finance index in Australia, and it broke support and looked really ugly, and now it's pounded its way back again. So I wouldn't write copper off yet. Particularly at this stage of the economic cycle, you would expect to see the commodity prices doing better. And this could be a reflection of what we're now seeing in Europe, which is a weakening of the economic manufacturing data and also a weakening of sentiment. And we'll look at the copper chart in a minute. Crude oil also slipped back a dollar and a bit to 73.80. I had to smile when I heard Trump is trying to strong arm the Saudis. I don't know whether that works or not. It all seems a little comical to me. But look, crude oil has been going up because inventory levels have been falling. That's really the long and the short of it, and I'll show you a chart of that in a minute. Whether Trump's rhetoric had any impact on crude oil, maybe a little bit in the short term, but when you look at the inventory data and the trends there, you'd have to conclude that the price of oil is more likely to go up from here than down. Energy stocks still not responding, which I find intriguing. They're still really in neutral at the moment. But if the oil price does keep trending up, then the energy stocks will kick in, that's for sure. So there's the spot copper chart. That looks really nasty. You can see $3 was a key support, and we've just blown it away in the last week or two. So it remains to be seen. I still would be looking for opportunities in copper, confirmed opportunities. I certainly wouldn't be trying to catch this falling knife in either copper or copper stocks, but we are really in a great point for commodities in the economic cycle. The latter part of the economic cycle is generally strong for commodities. We also know that copper is going to be in a significant supply deficit no matter what anybody does, starting really from now. So it seems pretty unlikely that the copper price is going to continue to fall. So I'll be looking for some opportunities there. There's the crude oil chart over the last 3 months, so you can see the upward trend. And this is the crude inventory levels. So the light blue line is 2017, and this is the weekly change in crude inventory levels. And you can see that throughout after the first 3 months of 2017, basically crude inventory levels trended down quite strongly. And you can see they were a bit flat until just recently in 2018, which is the darker blue line, and they are also trending down now as well. So whatever inventory levels are trending down, then the price of crude oil is going to go up, and ultimately that's going to take stocks with it. All right, so just to finish off, as far as I'm concerned in the US market, the long-term trend remains in place. There's nothing to suggest that that is finished, and all the other factors that I talked about at the start of this video remain supportive of that longer-term trend. The short-term trend can't be determined. It could go up, could go down. I really don't know. I just know the setups that I'm looking for, which I went through in detail in Portfolio Analyst last week. That's what I'm focused on, finding the lowest risk, highest probability entries that I can, and just stay focused on that. And this week in Portfolio Analyst, I will be doing more on those ideal setups, because with this recent volatility, there's quite a few of those sticking their heads up as well. So that's it for this week. There's my contact details for non-members, and I'll be back with you next weekend. Cheers.